Not every company is a fit for venture capital financing. So I'm going to dive into some alternative fundraising and financing options you have as a startup. And in fact, actually, a very small percentage of companies are actually a good fit for venture capital. And so most companies fall outside of the scope of that investment class. But there's a lot of ways to grow a business, and I'll talk about a few now. So the first alternative funding source is bootstrapping, and it's solving the problem by revenue and selling to more customers, using resources that are already available to you, whether it be through accelerator, through your friends and family network, through your customer network. Really, this is any way that you use free resources or creatively leverage assets to grow your company. That is bootstrapping, and that is definitely a great option to consider at any stage in the business. You can also look into crowdfunding, and this has grown a lot over the last 5-10 years, and I think it will continue to do so. With crowdfunding, the basic idea is instead of raising a lot of money from a few people, you raise a lot of money from a lot of people. And so the average contribution size is much smaller. It might go from $50,000 to $2,000 or $1,000 or even smaller, but you're able to engage a much larger audience of people. There's equity crowdfunding where you're actually selling shares in your company, and then there's non-dilutive crowdfunding, which is donations. You might be doing pre-orders on Indiegogo or GoFundMe. You can look at traditional debt for your company, and so that is a loan that you might get from a bank, a small business loan, SBA loan, or it might be an unsecured loan that you get from an uncle, and they kind of just give you a handshake agreement that you'll pay it back. And this is something that can be useful if you just need a small amount of capital and you expect to see cash flow in the beginning to pay the loan back, but you want to be careful, and if you don't have path to revenue or path to income, you don't want to get in over your head. And you also want to be conscious on, are you personally liable for the loan, or is the business liable and you're protected as an individual? Another alternative fundraising option is venture debt. This you actually have to raise venture capital in order to unlock this, because it's essentially debt that's given to a company and using the venture capital investment as credibility. And so when you receive maybe a $5 million investment from a VC firm, you can go to a handful of specialized banks to get venture debt and actually get maybe $1 million of debt on top of the $5 million in equity financing. One other option for financing I'll walk you through is traditional private equity. This is often not the first choice for entrepreneurs, because venture capital investors require you to give up less of your company, and so they invest at higher valuations, friendlier terms. A lot of times private equity investors will take a controlling interest and a majority stake in the company, but that doesn't mean it's a bad thing, and that doesn't mean the company can't grow and that there can't be an outcome for everybody involved that's positive. And so certainly an option, but generally it's for companies that aren't on as high growth scale as some of the breakout companies you've seen, like Apple and Microsoft and the big companies backed by the VC firms.